$1 million. For decades, that number was the finish line, the moment you made it, the point where money supposedly stopped being a problem. But here's the strange part. Today, when someone's net worth quietly crosses $1 million, almost nothing changes. No fireworks, no secret club invitation, no financial superpowers unlocked. Just a number on a screen. And yet, behind that number, a completely different financial reality begins to form. Because hitting $1 million doesn't make you rich. It changes the rules of the game. For most people, money works in a very simple loop. You work, you get paid, you spend most of it, maybe you save a little. Repeat for 40 years. That's the system most of us are trained to live inside. But somewhere along the way, usually after years of investing, saving, and compounding, a strange shift happens. The moment your net worth crosses about $1 million, the math starts behaving differently. Not emotionally, mathematically. Let's say that $1 million is invested. Stocks, index funds, retirement accounts. Nothing exotic. Historically, global stock markets return around 7 to 10% per year on average over long periods. Which means, in a typical year, that $1 million might grow by $70,000 to $100,000. And here's the weird part. That growth didn't come from your job. It came from the system. From businesses growing, from profits, from dividends, from the invisible machinery of the global economy. In other words, once your investments reach a certain size, your money starts doing more work than you do. But it doesn't feel that way. Most millionaires don't suddenly feel rich. In fact, surveys consistently show something almost absurd. Ask someone worth $1 million if they feel wealthy. Most say no. Ask them how much they'd need to feel wealthy. The most common answer? About $5 million. The target moves. Always. Psychologists call this the hedonic treadmill. Your lifestyle adjusts, your expectations rise, your definition of rich quietly drifts further away. The milestone you chased for years starts to feel like the starting line. But something else changes too. Something less obvious. Volatility. When you're building wealth, market swings feel like background noise. A few thousand up, a few thousand down. But once your net worth reaches 7 figures, the numbers start moving differently. A normal 1% market move suddenly means $10,000. A rough week in the market? You might watch $40,000 disappear from your portfolio before Friday. Not because you did anything wrong, just because markets move. And psychologically, that takes getting used to. Because for the first time in your life, your investments might fluctuate more in a month than your salary earns in a year. But here's where the system becomes truly strange. At around the $1 million mark, the focus slowly shifts from earning money to protecting it. Taxes become more visible. Asset allocation suddenly matters. Risk becomes real. Because losing half of $10,000 hurts, but losing half of $1 million changes decades. This is why many wealthy people quietly become more conservative over time. Less speculation, more preservation, more focus on stability. The goal subtly changes from getting rich to not getting poor again. And then there's the biggest misconception of all. The idea that $1 million means financial freedom. In reality, the famous 4% rule tells a different story. It suggests that historically, you could withdraw about 4% of your portfolio per year without running out of money over a 30-year retirement. So if you have $1 million invested, your sustainable income might be around $40,000 per year, before taxes. Not exactly the luxury lifestyle people imagine when they hear millionaire. In expensive cities, that barely covers living costs. Which explains something fascinating happening in modern finance. The definition of wealthy keeps drifting upward. Decades ago, $1 million meant mansions, yachts, and permanent retirement. Today, in many places, it simply means you played the game correctly for a long time. But despite all this, crossing that $1 million threshold still matters. Not because it makes you rich overnight, but because of momentum. Compounding starts to accelerate. At $100,000, a 10% return adds $10,000. At $1 million, the same return adds $100,000. At $5 million, it adds $500,000. At some point, wealth stops growing in straight lines and starts growing in curves. This is why the first million is famously the hardest, because every dollar before that point had to come mostly from effort. After that point, a larger portion begins coming from ownership. Ownership of companies, ownership of assets, ownership of the system itself. And that realization can feel unsettling, because it exposes something about the modern economy that most people never see clearly. The system doesn't reward effort equally. It rewards capital. The more capital you already have, the faster the machine works in your favor, which raises an uncomfortable question. If $1 million is no longer the finish line, and the real power comes from owning assets that compound indefinitely, then maybe the most important question isn't how people become millionaires. Maybe the real question is, what happens to everyone else who never gets close?